Smash.
Well, I guess it continues for another week. They sent the order out, ordering their Hulk to smash, and that's what they continue to do.
Hulk smash, little man!
Last week's beatdown wasn't enough. They knew they couldn't take their hand off the silver price for long because the proverbial beach ball they've been holding underwater was about to erupt. As you can see here, silver was well on its way. The LBMA was running low on silver and crying uncle. Refiners were working double time to produce 1,000-ounce bars, and retail was just starting to get excited about silver. Silver didn't just cross over into $50. It was moments from $55 on October 16th. And then they told Hulk to smash on Friday the 17th. So we were all interested in seeing what the metals were going to do this week. And as the kids like to say, we got to see it through. And that's exactly what they did. This wasn't normal profit taking or liquidation. This was full-blown Hulk smash on momentum and price. In hindsight, we all probably should have seen this little magic trick coming, because when silver starts to move like this, when it starts to grab attention of the public, it exposes how fragile the entire system really is. So let's talk about what just happened, why it happened, and what it really means for stackers like us, because make no mistake about it, the fix is in, but we are very aware. So let me just say this one thing real quick. What is good, Stackers University? It's so wonderful to have you here with me today. Go ahead and hit that like button right now so you can just focus on what we're going to cover in this video. Thank you to investing.com for supporting this channel. And if you click on the link in the description, you'll get an extra 15% off their pro subscription and get access to the same tools and information I use on the daily. Now, I want to acknowledge that the last 2 weeks have been frustrating and even uncomfortable as we watch metals in our portfolios take some serious hits. It was especially painful after we started to see the tide turning and the system was showing stress cracks. For the first time ever, we finally started to see that regardless of there being 3 or 4 billion ounces of silver in private hands around the world, we just aren't selling at $50 silver, which means there isn't enough real silver to cover their synthetic promises. We were just starting to see the process of true price discovery when it comes to silver, and that's just simply a world they're not wanting to live in or a reality they want to face. Not with inventories thin, not with physical delivery already tight, and not with trust and fiat fading. While we tend to focus on the daily prices, they were concerned about something much, much bigger. They were focused on and stressed about Friday, October 31st. And no, I'm not talking about Halloween. As I've shared in previous videos, $50 is the line in the sand. And if they didn't smash silver, they knew there was no way they wouldn't be able to keep silver from having a monthly close above $50. A monthly close above $50 would be catastrophic for market makers. This would have created a stampede into silver at the worst possible time, at a time where they were most vulnerable. As I said, there's plenty of silver above ground, but not if we as investors aren't selling. What's even worse for them is if we do start selling, it's still not in the form that they need, which then requires time. They just couldn't have that. I believe this is the real reason for the Hulk smash. They couldn't stop $50 silver, but they could delay a monthly close for a month or two. So that's just what they did. The other reason for this attack was pure psychological warfare. It wasn't about value or the markets being overbought. Markets have remained overbought for far longer than we were. The stock market, we were overbought but not overvalued. Meanwhile, the stock market is both of those things. So what's the easiest thing to do or the easiest way to control a market? You would think it's about fixing numbers. No, the best way to control a market is to fix belief. People's belief in the system. Simply put, they wanted to send a simple message. Silver is dangerous. Silver is volatile. Silver can't be trusted. And it worked for now. The same folks who FOMO'd in at $52 are now saying, man, I knew it. I'll never buy silver again. This smash was about conditioning the general public when it comes to silver. Let's not forget, though, they still haven't fixed their supply issue, which created much of the price appreciation we saw. They simply fixed sentiment, which is more powerful in this particular moment. So let's go back to what we've learned about behavioral finance on this channel over the years, because the next phase of this bull market is about fighting your human nature. And I want to point out 4 key concepts in particular. 1, loss aversion. They know losses hurt twice as much as gains feel good to the average person. So they manufactured pain to reset emotions. 2, anchoring bias. They wanted to anchor everyone's memory to the crash, not the climb. 3, herd behavior. They triggered the sell cascade. All you have to do is one big player dumps, then the algos follow, and then retail panics. 4, availability bias. The next time someone hears silver, the first thought is going to be volatility, not value. You see the pattern? This wasn't just price suppression. It was a psychological suppression. They rather people chase the bubble in tech stocks and Bitcoin and treasuries and not gold and silver as real money, because somehow you and I are in the risky investments. So it's not all bad, because they haven't figured out that the real stackers like us see this as a gift. If you're still building your stack, you just got a discount. If you're already fully allocated, you're just watching the show. All they did was smash the dollar exchange value of silver, meaning how many dollars we can get for it. But they didn't do anything to destroy the true value. Finally, I want to point out that this is a normal part of a bull market. Markets don't go straight up and stay there. So thank you for the smash, because it just makes sure that we build additional supports under this price. This stair-step progression is what will prevent silver from ever going back to $30. Historically, after 20% smashes in prior bull markets, silver has averaged a 60 to 80% move within the next 6 months. So ironically, hey, thank you for the smash. I know history doesn't repeat itself perfectly, but it sure does love to rhyme. Regardless, where the rubber meets the road, you have to decide what to do next. As I see it, you can buy if you believe this is manufactured fear and want to increase your position for the next leg higher. You can sell if you can't sleep, and if this volatility is wrecking your nerves, that's okay. Take profits and run. Or if you've been in this game for long enough, you could just hold. You already know this is noise. What you do really depends on the type of investor you are and are becoming. This price smash feels like a collapse, but really it's confirmation that silver matters and the physical market is far more delicate than it appears. It's confirmation that manipulation is real but temporary, and the confirmation that people who stay calm in chaos always win long term. As Warren Buffett told us, markets are designed to transfer wealth from the impatient to the patient. In the comment section, how far do you think silver can get pushed down? Is there another reason why they smashed the price? Or you can simply put an A plus in the comments. If you received any value from this video, love stacking, want to show me some love, or if you just want everyone to know that you always stack smarter and never stop learning. All right, that brings us to the end of the education portion of the video. And now this is the sponsor portion, and it's being brought to you by a company I own and has performed very well for me, and that's Gold Mining Inc. With gold hitting north of $4,000 an ounce, a record price that has also been accompanied by silver prices over $50 an ounce, the gold mining sector has been appreciating in 2025. Van Eck, Ruffer, Goldman Sachs, and Sprott all have positioned in this New York Stock Exchange American listed company, GLGD Gold Mining Inc. And they are today's sponsor of the video. And they're special because it's a gold exploration company with over 10 different projects in the Americas, but it owns the largest positions of publicly listed gold companies, giving them exposure to additional catalysts and leverage to the gold prices at the same time. Gold Mining Inc.'s market cap is roughly around 295 million as of October 21st, 2025. Yet its portfolio of equity holdings, including cash positions, are about 214 million alone, based on October 21st's closing price and cash balances as of August 31st, 2025. And that's before any value whatsoever to its portfolio of exploration stage gold-focused projects across the Americas and any additional potential value and optionality from its uranium project located in one of the world's highest grade districts, the Athabasca Basin in Canada. Based on his most recent MD&A as of August 31st and the closing prices of underlying securities as of October 21st of 2025, as you can see on the screen here, they have 9.9 million shares of U.S. Gold Mining Inc., which is worth around 123 million. 21.5 shares of Gold Royalty Corp., around 76 million. 19 million shares of Nev Gold, which is quoted around 8.2 million, and 84.4 million shares of Australian Mines Ltd, which is quoted around $1 million. So their total equities holding are valued at approximately $209 million. And Gold Mining Inc. has a market cap of $295.3 million. All of these stocks values are based on closing prices of October 21st. Gold Mining has positions in these four companies, two of which have nearly tripled in 2024 so far. And above that, Gold Mining owns one of the largest gold and copper resource stage mineral portfolios in the Americas. We're talking about over 10 projects located in pro-mining jurisdictions in Canada, US, Brazil, Peru, and Colombia, with an estimated 12.4 million ounces of gold equivalent in the measured and indicated category, and an additional 9.1 million ounces of estimated gold equivalent in the inferred category. Please review Gold Mining's public findings for important information regarding it and its projects and its resource estimates, including the most recent annual information form and the technical reports referenced in them. And I want to highlight the São Jorge project in Brazil. The company commenced its largest ever exploration program in 2025 This is a project which is approximately 1 gram per ton of open pit resource with a regional growth potential on a 46,000 hectare land package. Targeting resource growth is important given the industry-wide challenge of reserve replacement as major resources deplete reserves rapidly. The gold mining portfolio includes increasingly scarce large-scale gold and gold copper projects in mining-friendly jurisdictions. If these projects are progressed successfully, they are just what the major operators will need to replenish reserves mined throughout production. These are projects in safe jurisdictions with infrastructural advantages and a management team with deep experience in building value over time. Gold mining's leadership includes mining veterans such as former Goldcorp CEO David Garofalo and serial entrepreneur Amir Anani, who serve as chairman. Insiders own over 10 million shares, showing strong alignment with the shareholders. If you want exposure to gold through a company with exposure to gold price, a pipeline of development projects, and interesting institutional and insider backing, Gold Mining Inc., New York Stock Exchange, GLDG, deserves a closer look. As always, make sure you review Gold Mining's public filings for more important information regarding it and its projects, including its most recent annual information and technical reports referenced in them. They are always available at www.cedarplus.ca.